Joe Terranova recently issued a bold call on CNBC, arguing that the S&P 500 is marching to 10,000 within the next 18 months, despite a chorus of skeptical bears warning of a market peak. During a broadcast on August 17, 2026, host Scott Wapner pressed his panel of analysts on whether this historic rally is sustainable or a classic valuation trap. By the end of this video, you will know how the battle between blowout corporate earnings and surging long-term bond yields will reshape your portfolio over the coming months. Let's hear the analysts on CNBC, and after that, I'll give you my own reaction breakdown to what they said.
Ed Yardeni had already taken his target to 8,400 for 2026, says we're going to 10,000 or beyond by the end of the decade. The Roaring Twenties in full effect. Why? Because earnings are amazing. Evercore this morning. Long-term stock market trend continues to be higher. We have the potential for a FOMO-driven overshoot. SPX 9,000 is attainable in the next 12 months, even if you don't overshoot on a valuation standpoint. Joe, what say you?
I think you can get to 10,000 in the next 18 months. I see no reason why not. I agree with the representation of earnings being at really a historic pace for the last 7 quarters. The market is kind of settling in as you move towards the back end of August. I think I'm hearing a lot of people say, okay, look at the market and maybe this is the opportunity to sell. There's universal bullishness and that's the reason to sell. And I couldn't disagree more with that. I think really what's happening as you move towards the end of August is the market's becoming more tactical. Okay, the market is identifying opportunities and maintaining those opportunities. So memory came back last week. Optical came back. We're maintaining that position. We're rebuilding positioning. The bullish momentum remains in place. Energy, we've spoken about the refiners. Same example there. Rebuild positioning, maintain positioning. And then financials. Look, once again today I'm looking. You've got Bank of America, 52-week high, State Street, Charles Schwab, PNC. So there's strength in financials as well. The market is more tactical. And just because it appears as though maybe volatility and the environment is a little bit slower, the market's not moving as fast, that is not a reason to sell. That's actually indicative of a market that is waiting to reaccelerate as we move into the fall and broaden out once again.
Okay. Thankfully, Weiss is not maintaining his positioning because he is no longer blending in with the wall. So we appreciate that. Appreciate you putting a new piece of art up, Weiss. What about you on this market? Yardeni, 10,000 by the end of the decade, 9,000 by the end of in 12 months for Evercore, 10,000 from Terranova. People are pretty bullish. I asked the question, too bullish or just right?
You know, I'm bullish as well, and I tried to think of what can derail the bullishness. We know earnings are good, and there's every reason to believe they'll accelerate. A lot of it driven by AI. So what are the obvious things that could hit it? Number one, if rates go up measurably, if the Fed starts tightening, and that'll be because of oil, or the consumer, which is still 2/3 of the economy, starts to weaken further. Now, I think the market's going to look both past oil and the consumer because it's really one and the same thing. So I am bullish, and of course there's always the AI trade, which right now shows no sign of easing up. So I'm in agreement the market could move higher, but I do think there's some risks out there, which I just named, which could derail it a little bit, but I don't really see any disaster.
Okay. Shan, what do you think about this market? Do you think people are getting a little too bullish or not really? Because there are a couple of other notes. Ned Davis research today, it's hard to be a bear in this business. History's favored the bulls. I think everybody knows that. But the long-term trend in valuations look extended. The tape's holding up, but we're watching for deterioration. Deutsche Bank asks, does something have to give? Right? Everybody is so glowing about this, what they call a near immaculate scenario where basically everything goes right. Is that a sign of watch out?
Well, I think you mentioned, Weiss just mentioned valuations, and so two areas of potential concern are going to be slowing AI capex or, an inability to rationalize capex, which obviously we haven't seen as part of the results over the last several weeks. Valuations, to Steve's point, actually we've seen PEs compress on stronger earnings, and despite the risk that Steve mentioned, which is real rates have been rising. And I think, Scott, if we were in a different environment where earnings growth was not as strong and as broad, this increase in the long end of the yield curve, not just here in the U.S., but outside of the U.S. as well, would be creating a significantly more consternation in terms of equity investors. But yet, this earnings growth has been the underpinning of this. I do think that there's going to be a bit more dispersion as we come out of this earnings season. There typically is. We're cusping into September. There could be some policy questions. And so I guess it comes down to is your view that the areas of earnings strength that we've had, which is technology, but broader technology.
Gosh,
but also,
at this point, kind of everything now.
But that's what I'm saying.
Just not as glowing as tech, but it's like you can't hate on any part really of the earnings picture. You're doing like 14% average for every sector in the market.
And when you say something like taking out one time, you still have earnings growth of 21%. That is incredible in terms of the breadth that's required. I would say the other thing to look for as we go into the fourth quarter is where you want to be positioned in terms of this idea of compute as an asset class. And NVIDIA brought this up last week with their memorandum of understanding. What does that mean? Does that mean memory? Does that mean networking? Does that mean hardware? And I think that's where you're going to have to be a little bit tactical, a little bit selective in the next 6 weeks or so, because those opportunities plus semis are probably going to be more attractive than what we've seen, for instance, in software in the short term.
Do we think, Jimmy, that this, what Deutsche calls this current equilibrium, do we think that's sustainable?
Yes, but for how long is the question? And I would say certainly through the end of the year. And the equilibrium that I see, and Shannon, I think you were pointing this out, is that the multiple, roughly 21 times next year's earnings on the S&P 500 is very reasonable for the growth rate that we're having in earnings, mid-20%, even if you strip out the one-timers. The problem, and I'm not going to say the problem, but the thing to consider is that growth rate of mid-20% is not going to last in perpetuity. That's why I'm not that comfortable going as enthusiastic into 2027. Let me be clear. I am not suggesting selling stocks. That's not my point. My point, though, is that over the last 4 years, including this year's, we've had well into double-digit percentage returns on the S&P 500. And I think that will continue through year end. But I think the bar for growth of earnings becomes much higher in 2027. We're looking at, roughly 14% earnings growth next year. And the slightest disappointment to those numbers could bring the multiple down. Now, let's be clear. We're talking about earnings growth and a market that should be going higher. But I think it's tough to predict a fifth year of double-digit gains. It's only happened once, the late 90s.
Why aren't people talking about, guys, give me the 30-year, please. Why aren't we focused and fixated more on that, the 30-year Treasury, which is now at 529? Okay,
so,
Warsh comes out of that Fed meeting, right, and reveals the fact there were 3 dissents. The talk seems to be much more hawkish, even though the action didn't match the rhetoric. Nonetheless, the 30-year yield shoots higher. We continue to have a lot of issuance coming on the market, right? These debt raises from the hyperscalers, among others. The concerns about the deficit and whatever other issues you want to suggest are leading to the fact that the 30-year yield continues to rise. It doesn't matter?
For now, it doesn't matter, but I think you're onto something, Scott. I do. I don't so much think it's the 30-year that matters as it is the 10-year. The 10-year, as I think we all know, has been in a range of 4% on the low end to 5% on the high end for about 3 years. And we do have to wonder if what the 30-year is doing is telling us that the 10-year is going to go higher. And if it goes above 5%, that could be a way of the world saying, listen, we're not going to finance indefinite deficits, whether it's at the federal government level or at the hyperscaler negative free cash flow level. But I want to make this point clear as well, that while it is wise of you, Scott, to bring up that question and for us to discuss it, this is not an action that somebody should take now, at least in my opinion. Somebody should not look at the 30-year at 5.29% and say, well, that's it. I got to get out of all my hyperscalers because higher interest rates are here. What the interest rate environment is reflecting is that there is greater uncertainty with Kevin Warsh, who is speaking much less to the media.
It does, Shannon, raise a question of, whether this is an opportunity to increase your exposure in bonds, or if if it's too early because you still think that yields are going to back up even further. I mean, I hear some people suggest that this is a generational opportunity, potentially, the way that the 30-year has backed up.
Yeah, and curve steepening is not getting the attention I think that it deserves. But I think that the reason why is that for right now, I think the equity markets in particular are looking at real rates rising as an indication of growth. You start to think about that in terms of inflation or valuation stress or that greater issuance, then it starts to look a little bit less tenable. But the overall steepening of the curve gives you as an investor significantly more latitude to add incremental duration, a couple of years, lock in some nice yields, and then potentially benefit if, like we expect, the Fed doesn't hike this year. You're going to see that come in as you get closer to December, and you could have already locked in what have been much more attractive yields than they were at the start of the year.
Wapner opened the discussion with a striking list of facts. The volatility index is scraping the bottom of its yearly range. Every single sector in the S&P 500 is trading in positive territory. And prominent market strategist Ed Yardeni had just lifted his target to 8,400, predicting 10,000 by the end of the decade. With the phrase, Roaring Twenties hanging in the air, Wapner put the question squarely to Joe Terranova. Why should anyone believe these astronomical targets are grounded in reality? Terranova did not hesitate. He pushed the timeline even further, claiming the index could hit 10,000 in the next 18 months. His primary justification is a fundamental one. Corporate earnings have maintained a historic pace for 7 consecutive quarters. While some market participants look at this universal bullishness as a contrarian signal to take profits, Terranova strongly disagreed. He argued that instead of stalling, the market is turning highly tactical. Rather than a blanket rally, capital is rotating and rebuilding positions in areas like optical tech, energy refiners, and financials. J.P. Morgan Chase and Goldman Sachs, as proof that the rally's foundation is broadening far beyond just a handful of mega-cap tech stocks. For Terranova, this isn't a market on the verge of a cliff. It's a market that is actively repairing its own vulnerabilities under the surface. When one sector gets too expensive, the capital doesn't flee to cash. It rotates. I spent some time dissecting this rotation thesis, and it's a compelling argument on the surface. When you look at the equal-weighted S&P 500 compared to the market cap-weighted version, we are finally seeing the rest of the market play catch-up. This is exactly what bulls want to see, because a market supported by 400 stocks is infinitely healthier than one propped up by only 4. But here's the critical question we have to ask ourselves. Is this rotation a sign of genuine economic strength, or is it a defensive crouch disguised as an offensive move? Think about it. Investors are moving into financials and energy because these sectors are perceived as safe havens, with real, tangible cash flows in a high interest rate environment. That isn't necessarily a sign of a roaring economic expansion, it might just be a tactical retreat from the nosebleed valuations of software and silicon. This is where the debate on the CNBC panel got incredibly sharp. Host Scott Wapner turned the floor over to Liz Young, who wasted no time throwing cold water on Terranova's 18-month timeline. Young pointed out a glaring inconsistency in the bullish narrative. The market is currently pricing in both a massive surge in corporate earnings and a series of aggressive interest rate cuts from the Federal Reserve. Historically, you don't get both. Markets' expectations are wildly ahead of reality. Total, 743. But let's play devil's advocate for a moment and look at the other side of the ledger. During the panel, the discussion turned to the banking sector, which has quietly emerged as a pillar of support for the broader market. Financial institutions like J.P. Morgan Chase, ticker symbol JPM, have reported incredibly strong net interest income, benefited by higher for longer rates. If the economy manages to pull off a true soft landing where inflation trends down to the Fed's target without triggering a recession, then these traditional cyclical sectors can easily pick up the slack if mega-cap tech starts to cool down. This cyclical rotation is exactly what Terranova is banking on. Total, 854. It is a beautiful theory, but it relies on one massive assumption, that there is enough systemic liquidity to keep the entire machine running. And that liquidity is directly controlled by the bond market. Throughout the CNBC broadcast, the shadow of the 10-year Treasury yield loomed large. When bond yields spike, they act like a gravity well for asset prices. A higher discount rate automatically reduces the present value of future corporate cash flows, hitting hardest on growth stocks whose profits are projected years into the future. If the bond market starts to demand a higher term premium due to soaring government debt and persistent inflation, the S&P 500 will find it almost impossible to maintain an upward trajectory, let alone reach 10,000. This is exactly the tension that Scott Wapner highlighted when he pushed back on the idea of an easy path to 10,000. He asked how we can expect valuation multiples to expand when the risk-free rate of return is sitting comfortably above 4%. For the last 15 years, investors had no alternative to equities, a phenomenon we all called TINA. Today there is a very attractive alternative. You can lock in a guaranteed 5% yield on short-term government debt without taking a single ounce of corporate risk. Why would a pension fund or an institutional allocator risk capital on a stock trading at 30 times earnings when they can hit their actuarial targets with risk-free bonds? Terranova's response to this is that equity markets don't care about the absolute level of interest rates as long as the economy is growing. But that assumes corporate profit margins are immune to the rising cost of capital. If that surprised you as much as it surprised me, let me know with a like and subscribe to the channel. Let's look at the math because the numbers don't lie. Many of the companies driving the S&P 500 have balance sheets insulated by massive cash piles, but the average mid-cap or small-cap company is sitting on a mountain of floating-rate debt that needs to be refinanced. This brings us back to Liz Young's warning. If the Fed keeps rates higher to combat persistent inflation, interest expenses will slowly choke off the very earnings growth that Terranova is celebrating. On the other hand, if the Fed is forced to cut rates rapidly, it will likely be because the labor market is deteriorating and a recession is already at the doorstep. My take is that the market is trying to have its cake and eat it too. It is pricing in a Goldilocks scenario where inflation vanishes, growth accelerates, and borrowing costs drop. It is a perfect blueprint on paper, but economic history suggests that matching this blueprint in the real world is incredibly rare. To understand how fragile this balance is, we have to look at where the capital is actually flowing. Let's take Microsoft, ticker symbol MSFT, which has been a primary engine of this bull run. Microsoft is spending billions of dollars quarter after quarter on artificial intelligence infrastructure, building out massive data centers to support the next generation of computing. Right now, Wall Street is applauding this expenditure because the company is growing its cloud revenues at an extraordinary pace. But what happens when the initial build-out phase ends, and the market demands to see the actual productivity gains on the bottom line? If the enterprise adoption of AI tools is slower than expected, these massive capital expenditures will start to look like overcapacity. The moment the market begins to question the return on investment for these tech giants, the multiple contraction won't just be a minor pullback, it will be a systemic re-rating of the entire index. This brings us to a major pivot point in the debate. While the panel focused heavily on institutional capital and sector rotation, they glossed over the engine that powers 70% of the American economy, the consumer. We are starting to see clear signs of fatigue under the hood. Credit card delinquencies are rising, auto loan defaults are creeping up to levels we haven't seen since the global financial crisis, and personal savings rates have plummeted. If the consumer starts to pull back, the cyclical rotation that Terranova is betting on will fall apart. You can't have a sustained rally in financials, retail, and energy if the average household is cutting back on spending to cover their rent and grocery bills. The idea that traditional sectors can effortlessly pick up the slack from tech assumes that the broader economy is fundamentally insulated from the pressures of inflation. It is a massive blind spot in the bullish thesis. Let's put some hard numbers on this rotation theory because scale matters in a market cap-weighted index. The technology sector makes up roughly 30% of the S&P 500. Financials represent about 13%, and energy is a mere 4%. Do the math. If tech drops by 10% because of a valuation reset, the financial sector would need to rally by nearly 25% just to keep the index flat. Energy would have to triple. When you look at it through the lens of pure math, the idea of rotation saving the index is a mathematical illusion. You cannot run a sustained bull market without the heavyweights. If the megacaps stall, the rest of the market simply does not have the earnings power or the market capitalization to drag the index higher. It is like expecting a rowboat engine to push an aircraft carrier. What we are really witnessing on the CNBC panel is a classic clash of investment horizons. Terranova is playing a tactical game. He is looking at the immediate flow of funds, the technical setups, and the momentum of corporate earnings over the next few quarters. And in the short term, he might be entirely correct. Momentum is a powerful force, and fighting a strong trend is a quick way to lose money. But Liz Young is playing a structural game. She is looking at the long-term debt cycle, the macroeconomic gravity of interest rates, and the historical reality that cycles eventually turn. For long-term investors, the danger isn't that Terranova is wrong today, it's that his timeline requires perfect execution from both corporate America and the Federal Reserve. Where does this leave us as we watch this historic tug-of-war play out? The critical indicator to watch over the coming months isn't the headline index level, but the performance of the high-yield credit markets. If corporate debt spreads remain tight, it means the bond market is comfortable with the refinancing risks, and the rally can likely extend its run. But if spreads begin to widen, it will be the first real warning sign that the high interest rate environment is finally breaking something. We are standing at a fascinating crossroads, where the momentum of corporate earnings is colliding head-on with the laws of macroeconomic gravity. Whether we hit 10,000 or find ourselves facing a significant correction will depend entirely on which of those two forces blinks first. Ultimately, the market's path will be dictated by whether the resilience of the AI-led earnings boom can outpace the tightening constraints of the monetary cycle. Keep a close eye on the upcoming earnings reports for any sign of margin compression, as that will be the first crack in the foundation. The next few months of data will tell us if this bull market has truly found a new gear, or if we are simply witnessing the final exhausted push before a reality check. Thanks for watching. Before you go, like the video and subscribe to the channel, and I'll see you in the next one.